Okay, everyone hear me okay? I'm seeing lots and lots of ones. Okay, today we're going to talk about the volatility contraction pattern. We're going to talk about why we use it, how to use it. We're also going to talk about pivot points and being somewhat creative with pivot points and showing the different ways that some of these pivot points can develop. Of course, we're not going to be able to cover everything today, but we'll be able to at least have a good tutorial on the volatility contraction pattern. Of course, there's a whole section in my book about this, and what we're showing you right here, what we call contraction tees, is from my book, figure number 10-.4, of course. We'll start with that, and basically what we're looking for when we're going into these stock trades is some type of volatility contraction, and it can develop in a number of ways. Now, a few things I want to start off talking about is, first of all, you have to have patience to wait for these setups to develop. You know, it doesn't mean that just because the market's going up that you're necessarily going to have a whole bunch of these setups developing, and it also doesn't mean that whether the market is going sideways or not doing much, that you won't have a bunch of them setting up and you'll be able to make a lot of money when the market's not doing very much. That's why I'm always saying concentrate on the stocks. And when you see a lot of these volatility contraction setups starting to proliferate, it's usually a sign that the market is pretty healthy as far as the individual stocks in the universe that we're trading is concerned. And also it's a pretty good, excuse me, sorry. Also it's a pretty good sign that the general market is relatively healthy too. Now, if we get pivot failures and we start getting base failures and these contraction patterns start falling apart, of course that's not the greatest sign. That's what we've seen recently. But I want to talk about a few reasons why we're going to look for this volatility contraction. The first reason is to find and establish a low-risk entry point. Now, what is a low-risk entry point? This is where we want to be able to allow a stock price the ability to fluctuate in a normal fashion, but not stop us out. And if it does stop us out, we want to know that something abnormal is happening. So then, of course, the trade would sour and we would get out of it. And the second thing is that we want to be able to know that fairly quickly. So we're looking for the stock price to establish the line of least resistance. And that is where, when you get to that point where you get that's why it's called specific entry point analysis, because we're very, very precise and specific of what we're looking for. And we're trying to time that trade, not just because we're trying to time it to be at a profit right away. Of course, that's the goal. But we also, if this trade isn't going to work out, we'd like to be at a loss right away, because then we avoid having to sit there and tie up the capital for extended periods of time. Instead, we can redeploy that into something else that might be setting up and looking better. Also, we want to be able to maintain our losses at a level that's acceptable based on our average gain and what we're able to expect on the upside. So with that said, let's take a look at a few charts here. I have some charts that are going to be from my book. There's a few that we brought in from the Master Trader program, and then there's some new stuff that we're going to look at that we pulled from some recent examples. Let's just first start off with looking at this stock here. This is a stock I traded in 07 that tightened up quite nicely, and you can see that it goes through this contraction phase, and this happened over 15 months. So the first correction here was 31%. The second time that the stock made a little short-term top, then pulled down, was 17%, and then it got a little tighter. You see it was 8%, and then it got really tight just for a day or two. And that's what you're really looking for. You're looking for right in this 8 to single digit to sometimes it's 10 or 8%, or sometimes as little as just a few percent. And then you want to see that volume contract, and that's where you get the VCP starting to conclude and that line of least resistance being formed. And as it starts to move through there, that's where we're looking to buy. Now, if we were to take this and just pull this off of the chart, you would see what we call the VCP footprint. And I have used a little abbreviation that allows me to be able to very quickly know what a stock looks like without even looking at it, just by looking at this abbreviation. So this is 40W, which stands for 40 weeks, 31 by 3 by 4T. So 31 is the largest correction on the left side, the smallest is the 3, and 4T means that it had 4 contractions. So by looking at this, this is sort of like if you told me, you know, a guy's 6'3", he's 254 pounds, and he's got a 50-inch waist, I get a pretty good idea of what that person looks like without even seeing them. So this is what we call the footprint. Now, we're going to, of course, we want the stock to be already in an uptrend. All right, I'm assuming that most of you understand and you've read my book, and that we want to be in a long-term uptrend. These are continuation patterns. Right, we're not looking to buy the bottom of a move. We're looking to already have some evidence that institutions are moving into a stock, and then once it corrects and it goes through an intermediate term correction, if that stock, if something really great's happening, institutions are going to add to those positions. Okay, they're going to take that stock even higher, and we're looking for those names that have already shown some type of evidence that they're under accumulation. All right, it's all about putting the probabilities in your favor and stacking as many probabilities as possible that you've got big institutions in there buying the stock, and you want to be able to get in there and take advantage of that, of course. Now, in order to take advantage of that, we want to find the spot at which supply really starts to diminish, and there's not a whole lot of supply. We're going to talk about this more in just a minute. A lot of people don't understand what it means, supply not coming to market. But very simply, it just means that there's not a whole lot of stock for sale at that point. So if there's not a whole lot of stock for sale, then that means that even a little bit of buying would actually move it, because supply and demand would dictate that if there's no supply, it doesn't take a whole lot of demand to get the price moving. Now, if we are already making an assumption that institutions are buying the stock in size, and then we find the spot where there's little supply, put those two things together, low supply, big demand. That's what makes these stocks all of a sudden just explode from these pivot points, because we're finding that line of least resistance where it's not magic, it's just simply supply and demand, where that's the point at which supply is very low and that demand is still there and comes back into the stock. Now, this will show up also on a weekly chart. You'll see we're looking at FSI International. I traded this stock back in February '95, and you'll see this is a 10-week, 18 by 5 2T. So we had that one correction that came in, about 18%, fairly tight, and then just had a little 5% little handle here. This is just a classic cup with handle with VCP characteristics, and it has 2 time frames or contractions, if you want to call them. And you can even see on a weekly how the volume contracts here, and then when it starts to break out, the volume comes out here. Now, I always like this example, of course, and I talk about this in my book, Netflix. A few things that are I think, interesting about this is, number one, let's just zoom up here a little bit and take a look at Netflix versus Blockbuster. First of all, you'll see that almost to the day that Netflix, which was the big competitor ultimately to Blockbuster, almost to the day that they come public, Blockbuster tops. Almost as if the money that was in Blockbuster was sucked out of Blockbuster and started going into Netflix, which was the new kid on the block and had the better business model. But it wasn't until the Blockbuster was virtually vaporized down to a bulletin board stock, at which we've got that really perfect VCP setup that gave you that chance to get involved when it really started to pick up its momentum. And you can see there's a big difference between, even though this is a pretty big gain here, you'll see this big sideways action here for years. So it doesn't have to happen right away. This could take a lot of time and then eventually develop. But if you were watching just in your neighborhood and you start to see Blockbusters going under and mom and pop stores going under, and you knew much about Netflix, you would have maybe perked your interest up and be able to see this technical setup and taken advantage of this. So you'll see once Blockbuster is basically smoked down to nothing, Netflix takes off and makes, of course, a huge, enormous gain. Now, this is looking at it on a weekly. You can see that it goes through a perfect VCP setup here and tightens up very nicely here on the right side. We were buying this as it came out here. This is actually a stock that we put on the service, and I was actually buying this and held it for a longer term move. It made a very nice move, of course, Netflix, most of you are familiar with that. This is nothing new, by the way. You know, we constantly hear that, you know, it does these things, you know, oh, maybe they worked in the past, but do they work now? And, you know, it was in a bull market or whatever. There's always some excuse people are trying to put on your success or some type of rationale for their inability to have success. But the fact is that these are timeless principles. They're not going to change. They haven't changed much in 100 years, and they're not going to change much in the next 100 years. I can assure you that. So, you know, if you're not able to take advantage of these things, you're not able to spot them, it's just because you need to spend more time working on honing your skill, and eventually, if you stick with it, you'll be able to understand it a little better, maybe take advantage of it a little better. But the fact is that these are timeless principles that will last forever. They're just based on supply and demand. It's people don't change very much, and human nature doesn't change very much. This is Xerox, of course. This is a big, huge volatility contraction, but you can see even here how we tighten up, and this is just before it made a big move. You can go back, and I mean, we have models going back into the 1800s, late 1800s, the early 1900s, when, you know, Coca-Cola was the monster beverage of the day. It had huge earnings of 500% per quarter. We put in a cup with handle with a volatility contraction, it took off, made a multi-year move, hundreds and hundreds of percent, thousands of percent actually. So here's Starbucks. You can go back and, you know, trace some of the biggest winners and names that at the time when they were coming out of these little bases and coming out of these volatility contraction patterns, nobody really even knew who they were. It was very hard for me to ever find someone that knew who Yahoo was, or Dell Computer, or Amgen, or even Starbucks and Amazon. I remember for years I couldn't get anybody interested in Amazon, my institutional clients. Nobody wanted to touch Amazon or Yahoo or any of those names. It wasn't until years later when the stocks were up 5,000, 10,000% that those same institutions were then looking to buy them when they became household names. So this is, and these volatility contraction setups can happen right off of a new issue, so shortly after, and so you have what we call a primary base. It's a great way to take advantage of a company that just comes public, or it can happen to a stock that it can occur in a stock that's been around for a long period of time and is a household name. I find they work the best in the smaller cap and mid cap area that's not followed as much. So you can see here, this is very tight action, and you'll see we set up this third T. We get very tight here and break out here and very efficiently. Here's the Yahoo that I was talking about. I was actually buying Yahoo right here, right as this week as it came out here, and it came in for a few weeks, and when it took out this high, I added to my position, and I was in Yahoo a number of times during this run. It went up almost 8,000% the following 2 years. Now, again, let's go back. We'll talk a little bit about why this happens and what actually takes place. For some of you that already know this, try to sit through it for a minute, and those of you that don't, it'll be interesting. First of all, there's a reason why these sort of cup with handle or volatility contraction or 3C setups that we talk about, or you may have heard, you may have read William O'Neill's book with the cup with handle, or you may have gone back to William Giller, the saucer with platform, and these various terms that we have. I learned how to get in a little bit earlier than that handle and started using what we call the cup completion cheat, or the 3C, the low cheat. There's a reason why that most of these names emerge from a very similar type progression, and that's because of, once again, because of supply demand. So let me explain to you what takes place. You have a stock that maybe, you know, it's up, it could be up 1,000%, 50%, 100%, doesn't really matter. The fact is that there's some buyers that get themselves trapped in the stock as the stock declines and goes into a correction. Now, at some point, that stock is going to bottom out, and there's always buyers and sellers in a stock, so you're going to have inevitably some buyers around that low. So when that stock moves up that right side and starts coming back into that spot where you had buyers previous, you're going to have the intersect of two types of people in the stock. One is people that bought at the lows, and they're at a pretty nice quick profit as it runs up this right side. And two, and those are potential sellers. There's short-term traders in there that are going to want to take some profits. And then it's going to come back to these guys who got caught in the stock and they're trapped, and now it's coming back to their break-even point. So now that's what forms that pullback in the right side, or what you would refer to as a handle, or what I refer to as the turn down here. As the stock comes up and it gets closer to these people that were trapped and it gives these people a profit, you get some selling that takes place. Now, here's where it's really important to watch very carefully, because if this stock is under accumulation and you have that long-term trend and you did your research, the earnings are big, the sales are good, there's maybe a new drug that's under review and it's going to get FDA approval, and you see that big volume in there, that there's some demand, big demand prior in this uptrend. Well, if institutions are going to accumulate this stock and keep accumulating it as it corrects, what's going to happen is they're going to eat through this short-term supply. These are short-term oriented people that eventually are going to get absorbed. When they're finally absorbed, the stock starts quieting down, and that's where the volume will come in, and that's where you have supply stops coming to market. There can't be any more important words in trading than that particular sentence. Supply diminishes and stops coming to market, because that's where you establish that line of least resistance. And that's where, when you have a little bit of supply and you have a lot of demand, you can get explosive action. And that's how you can put together super performance returns. Whether you're timing these trades to get in for a big move and for a multi-year move and a key market leader, or you're just looking to trade them, the key is you don't want to be stuck in a stock just sitting there doing nothing. So, when I first started trading, I had to make a living at trading. I didn't have much money, so I had to make big returns, and I also I couldn't just sit around and wait. I wanted to know right away if I was right or wrong, so I could get that money into something else and keep rotating, and I wanted to be able to compound the money very rapidly. So that's how I developed these techniques for knowing if I'm right or wrong very, very quickly. Now, a few mistakes that you want to avoid, one of them being that you want to be real careful that when you have that correction as it pulls back, that it's not too deep. Okay, and what I mean by too deep, when you start getting over 50%, 60%, that's huge weakness, especially if the market is only down a small amount during that period. If the market's off, 40% bear market, you may get some stocks that are down 50%. However, in this particular instance, we've got a stock that's down 60%. Nasdaq's only down 6% during the same period. That's very abnormal. Now, there's a reason why this is very dangerous to start buying as it rallies back and starts putting in that right side and what may appear to be a volatility contraction, and it may look like one symmetrically. The problem is that, first of all, you've got a lot of supply. It's made this huge decline, so you have a lot of supply. And second of all, when it makes this big run, in order to come all the way back up here, it's a huge gain. This is 125% rally, so you have a lot of people that are going to want to sell there. The other problem is the fact that it broke so hard is an indication that there may be something really wrong, that there's a lot of institutions that piled out of this thing and maybe stopped selling because it just got too exacerbated. And now, as it rallies back, there's going to be more selling that hits the stock, and that very often is what happens. You get, maybe there's a problem, and then you get a lot of trapped buyers, and then you get a lot of profit takers. You put that all together, and the stock gets overwhelmed by that supply and comes crashing down. So you have to be careful that those corrections aren't too big. Just the opposite, what you want to look for is you want to look for the stocks that correct the least amount, okay? And like an environment we're in right now where the Nasdaq's come down, you want to start looking for accumulation. All right, we saw a little bit of accumulation off the lows here, which I'm not going to put a lot of weight into because it's just one day. We had a reversal, there was some volume, and I explained how that's what we were looking for. It's exactly what has taken place so far. There's more work to be done here, okay? Now, what you're going to look for, though, is you start getting that accumulation, you might get a pullback and then more accumulation. As the market is moving up from its lows, you want to look for the stocks that are starting to move up from their bases and their pivot points and their VCPs. And then as the market pulls in, you'll have natural reactions, and hopefully most of those stocks will hold up, and you'll be able to move to new high ground in the next rally. Now, this doesn't have to happen in any particular order. Sometimes the general market bottoms, and the leaders start breaking out of these bases after. Sometimes you get a whole bunch of stocks that set up before the market really puts in its final low, and they start to break out, and you get sort of a heads up. I think this time around, we may be a little more lagging on the stocks, and the market may bottom before the stocks. That's my feeling. But again, I'm not going to really trade on my feeling. I'm just going to watch the stocks, and when they start to put in those VCP patterns, we'll start to take some positions. Now, this is CMG, and you can see how while the market is going through this correction here and trying to form a bottom, you can see what's happening here. The stock is tightening up, and it's forming a perfect VCP. Here's your previous uptrend, so you're in that stage 2 uptrend already, and now you get that intermediate term correction. And as that starts to emerge, you can see the market's still pretty close to its lows. It's just starting to come up from the lows. This was the 2010 bottom, but CMG was just breaking out, and it may have looked high price to a novice trader, but this was about to make a very big move. If you take a look here, now these moves could be very efficient too. This CMG is a really textbook case where we're looking at a weekly now, and this is the VCP that we just looked at. And you can see that, look at these weekly closes. I mean, we're talking 12 out of 13 weeks the stock was up. If you time the stock properly, particularly if you're timing these trades off of a general market correction, you can really get yourself onto a really big leader that can make a heck of a move. And even if you just wait for the first 1 or 2 down weeks, it could go an extended period. Now, on the opposite side, stocks will tend to top as the general market is experiencing the opposite of accumulation, and that's distribution. And that's why you want to be very careful when you start seeing those distribution days. And we keep account of that. And of course, you can read IBD. They keep account of distribution. We have a little bit more elaborate way that we watch the market with our risk model parameters. But the basic way is to just watch that. Watch those general market indexes like the NASDAQ Composite and the NYSE, and look for the accumulation distribution. Right now, we've had a lot of distribution. We're just starting to experience a little bit of accumulation, but not enough to really give us an indication that that this market is bottom. Now, prior to when we were just starting to roll over in this market, if you remember, for those of you who have been with us long enough, if you remember back weeks and weeks ago, probably 3, 4 weeks ago, 5 weeks ago, I was talking about being a little careful at stocks that break out as we're getting distribution in the market. And that's because what happens is, and if you remember, I said how we could break out and some of these names will go up 5, 10%, and then they roll over, we start getting pivot failures. Your probability of success really goes down quite a bit when you have a lot of distribution days piling up in your late stage in the market, which that's the situation that we were in over the last 2, 3, 4 weeks. And then what will happen is you'll get sucked in, and you'll either top ticket or won't get enough gain really to even sell it and take a profit, and then very quickly the stock will roll over, and you'll get a breakout failure, and you'll get a pivot failure, and then if it gets worse, there'll be outright base failures. Hopefully you'll be out of the stock way before that. You shouldn't be in a stock waiting for a base failure, and that'll give you an indication of that whether the market is healthy or not. So that's one of the reasons why we've been bearish on the market, because we saw these names that were late stage, we saw the distribution, and then we saw the pivot failures. So that's really all you need to know. You don't need to know much more information than that. If you want to look at the TV and look at all the indicators and listen to everybody's elaborate theories, that's fine. But this is really all you need to know, is to watch the distribution and watch the stocks, and you're going to get a pretty clear-cut idea of what's happening in the market with your own 2 eyes. Now, this was a stock that we actually traded. We actually tried to trade it up here on a little pullback, and then it just rolled right over. And I actually gave it a little bit, I think, too much room, because the distribution day came in after the stock broke. But when looking back, the stocks were breaking down, were really giving sort of a heads up a few days in advance. This was a name that ALK, of course, in the airline group, that came out of this base, came in here, tried to put a little pullback buy, tried to emerge, reversed, and then just came right in. And then right here, this is where the big distribution day came. It was huge volume in the market. It's the general market, NYSE Composite, and just had a big outside day there. Now, it doesn't mean that you take your eye off of some of these names just because they stop you out. Here's a situation where you know, the stock tried to emerge and then came in here and then went through another big VCP, a larger base, sometimes a failed short a setup that's a short in duration turns into a longer duration setup, and it's even stronger. And in this particular situation, if those of you who have been following the airlines, a lot of airline stocks have been going up since, and you can see we reset and then went through this big base, and then you've got back to the VCP characteristics where it could emerge and then break out from there. So now you can have the right stock, but it's too early during a market bottom, and that's what right now, you know, I'm being very careful of. You know, we don't want to get in here and start buying a whole bunch of names and okay, the market's bottom, and just rush in without seeing a bunch of these VCP setups, or at least a handful, start to work out. And that's why I always say be incremental. Go in there, you try a few names, you take some pilot positions. There's just, you know, if you can't make money at 10 or 15 or 25% invested, there's just no reason to step it up and to move to 50 or 75 or 100%. It just doesn't make any sense because the market's telling you that things aren't working. And so just the opposite, if things are working and you take a few pilot positions and you start seeing accumulation in the market and the stocks start working out, well, then you should have the confidence to step it up. And that's exactly what a lot of traders have trouble with. They have trouble with pulling the trigger and getting in there, so then they wait too long until the market's run up, and then later on they go, oh, well, I should have bought that one and that one and that one. That's why you got to really just tune out all your, you know, all the outside noise and your own emotions, and be incremental, and just be very intelligent about this, and look at the evidence and trade it. The other thing is you can have the right stock, but you're too late. The market's actually topping, and that. What happens is after a period of success, you start to get a little sloppy because things have come maybe a little too easy, and that's a sign that also that maybe, you know, you're going to start having some trouble in your trading. And that's sort of a situation that we got into recently also. If you remember, we had a lot of success with, you know, good percentage of stocks that were working out, and then all of a sudden things weren't working so well. We're getting stopped out one after the next after the next, and I pointed that out, that in itself was a sign that things probably aren't right here, okay? Now, if you have a good strategy and things aren't working, the only thing that could be wrong is the market's not right. So otherwise, you got to check your criteria, and maybe you don't have very good criteria, and your criteria is flawed. Now, again, going back to why do we go in and try to buy at these low-risk entry points? And, well, first of all, you know, I've heard people say, well, I was down 30% on a stock and I bought more, and it went higher, and I eventually made a big gain on it. Why should I do that if it's a good company? Well, because it doesn't always work out that way. And if you're buying more of a stock that's down 20%, or you're holding it down 20%, who's to say it doesn't go down to 30, 40, 50? You can look at, you know, any big bear market, go back and look at some of your favorite names, and you'll find that they're down anywhere between 50, 80, and as much as 90%, and some go out of business. So those aren't the type of losses that you can recover from. So, you know, protecting that downside is really important. And yeah, you know, just because you get a good outcome because you do something stupid doesn't mean, well, not that even that whether it's stupid, it just may be you know, where it's you're ignorant to the facts. You know, you just don't know any better, and you're thinking, you know, well, I've heard that, you know, GE is a good company, and I've heard buy low, sell high, so this stock's down here, and you may get away with that for a while. But the fact is that you really have to manage that risk in relation to your reward. So there's a big difference between making a 20% gain, taking a 5% risk, and making a 20% gain, sitting through a 20% decline. That's not going to work out over the long term if you're taking 20% risk for 20% gains. You know, this risk-reward relationship really has to be kept intact. Let's get back to looking at some examples of VCP and start putting things together here. First of all, you also want to look, you know, this isn't just in a vacuum. Now, you could just trade on pure technicals, but why use just technicals when you have other information that's very valuable? The majority of your names, the majority of your trading should be in names that are already showing profits, that are showing earnings on the table and sales on the table. Like most big winners have the earnings and sales already on the table, and they're usually pretty big in the most recent several quarters. And you can also go back a few years and usually see some type of margin improvement or some acceleration in the sales, and then ultimately it will show up in the earnings. Now, Foster Wheeler, this was a stock that also traded in '07. You'll see a few things that make this a constructive setup. First of all, the fact that we had some good fundamentals, very big earnings and sales in 2006 going to 2007, and you'll see the margins, the net margins went from almost zero, negligible, to 6.1, and then from 6.1 to 7.7. So we had an expanding net profit margin situation. In this big quarter in March of '07, in the March quarter, you'll see here too, we undercut this previous low. And again, you could look at this in my book about big demand days, a previous low. And again, you could look at this in my book about big demand days, about shakeouts. This is a shakeout. We take out some previous lows, and we come off pretty hard here. It's about 30%. But then we rally back and we start to tighten up and go through that VCP setup. And you'll see ultimately we tighten up to just a 4%, just a 4% little range here. And if you come down here, let's zoom up a little bit. You'll see how the volume contracts. It really comes in here, and you see you really can't hide this difference in volume. I mean, just look at this volume and look how the breakout volume. And this actually broke out on earnings and gapped, but the gap wasn't big enough really to cause a problem. It still gave you a nice little stop that was only about 5% or so. So I bought this when it came out on the earnings, and then of course the volume just exploded, and this stock made a pretty big move. Now, taking a look at it, here's the daily coming out of that very tight setup, and just, you see this move, how very efficient it is. And you'll also notice that at the time, I mean, if you were to look at the valuation, it was trading at some of the highest PE that it's seen, but that PE expanded even further quite a bit. You can get sometimes PE expansions of 100, 200, even 300 or 400% before a stock tops. So don't get nervous if you see the stock breaking out of these bases and you're at a high PE. Sometimes you'll be at a it seems like it's in the stratospheres. I bought Yahoo at 900 times earnings, and then it went to 1,500 times earnings. So you know, very often you'll see that. Another thing too to point out is that you usually, when you get a big move in a stock, you usually get more than one opportunity. Now, one of the reasons why this is really important to understand is because investors are so impatient. It's because there's this fear. There's this fear of missing out. You know, there's a fear of when you go to take a loss that, you know, you'll sell it and then it'll turn around and go up. There's a fear when you're at a profit that I'll sell it here and the thing will keep going higher. You know, there's all these fears that dictate, but you have to realize that there's going to be lots and lots of stock setups, and not only will there be lots of different names of that setup, the same names set up many times too. I mean, I've traded, you know, some names probably 50 times, 100 times over the last 10, 20 years. You know, these stocks will give you a lot of different setups, and usually in a major move, you'll get 2 or 3. So, for instance, this is that VIVO. It came out here. This stock went up 150%, then set up and went up another 100%. So, you know, you're going to get multiple times to be able to play these things out. So don't be too impatient. I want to go over INCY, stock that we short-term traded. I don't remember the trade exactly, but we did a short-term trade or a swing trade on this. But I want to just take a look at how these things can develop, and some of the characteristics to look for. First of all, you'll see we get this first pullback here, this correction, which is of course your first T for contraction, and then we come in again. Looks like it's trying to form this right side, and you'll see it gaps up, and you get that big demand. We're always looking for some type of demand coming off the lows or on that right side, and then for the stock to quiet down. You'll see we come in here and put in what we call a pullback buy. Of course, a pullback buy is going to have to be another tutorial. We're not going to get into that too much today. But sometimes you'll get these contractions, and they'll also coincide with a pullback buy or a shakeout and a reversal and various terminology that you hear us saying from time to time. But again, take a look here. You'll see how the volume really comes in, starts to really contract as we get very tight here. So this is giving you a very low risk entry point, because now you know if this starts to move and break out and then suddenly comes back, you're going to get a widening of the volatility. It's going to not, you're not going to get alpha, you're going to get volatility. Volatility is back and forth. Alpha is direct, one direction. So if this can break out here and hold up, you'll stay with the trade. If not, if it pulls in and it should maybe take out this low here, and, or maybe you sell, that's a little too tight, and you sell a little stop that's a little deeper than that, you'll know that the trade's not working. You'll be able to get out at a reasonable or a relatively small loss. So now you'll see here we get that nice spike in volume. So all things are all systems are go at this point, and we get some follow through, and then we have a little what we call natural reaction. So here 1, 2, 3, 4 days, it starts to turn up after 4 days, and we're in new high ground again. You'll see here the volume starts to pick up again. So that's a sign that the stock's probably going to move a little bit higher here, and you want to hold it a little bit longer. Now, what I often do, and when I trade these things, I might try to trade around my position, and I'll reduce and add. Here's a few general rules when I get into one of these names. Now, of course, if it's the beginning of a bull market and I think I'm onto a key leader, I may try to hold it and I won't reduce at all. But as we get later stage and I'll start trading ideas, and of course on our platform we do a lot of short-term and swing trading because we have to constantly have activity to be able to teach. It's it's an educational service more than anything. So but I try to show you guys how you can hold these things and either trade around the position or build positions and hold them for longer term moves and use additional selling rules. One thing that I do from a swing basis is I get in the trade usually, and then after it runs up, I'll try to let it go through that first normal reaction. And if I get tennis ball action and it just springs right back into new high ground, I'll give it a little bit longer, sometimes a few days, a few weeks. And if I can get myself at a decent gain at that point, what I'll do is I'll then reduce the position usually in half. I'll cut the position in half, and then at this point, I'll move my stop up to break even. And the worst case scenario is even if I let it come all the way back to break even, I'm going to capture that half position gain. As a matter of fact, you can add back the risk or add back the gain into the risk and then widen your stop and use the profits that you've made to cushion your stop and then give the stock even more room, and then you would still only break even on the trade. Now, in this particular instance, this worked out fairly perfect as far as the example that I'm talking about here is that you had that tennis ball action. If you reduced a little off here, you went to another VCP setup, and then at that point you can start adding back your position that you took off. So you let the stock go and rebase build, and now as it comes back up here, and you'll see it tightens up again, and you see how the volume here on these little down days gets very, very low, and then it starts to expand as it turns up, and we get the same process starts all over again. Now you're back in, say, a full position, stock runs up, you let it go through that first pullback, and you see there's tennis ball action. Maybe give it a few more days or even a few more weeks, and at that point you can reduce again. And then if this stock started to get itself into trouble, you see it start to lose its momentum and then had to close below the 50, this is where you could have maybe sold some more, sold the whole position, and of course the big decline came in here, and you had to be pretty quick to get out of there. So this is just a way that you can use the VCP to get in and then swing trade it and trade around your core position, and then if you can get additional setups, you can add back your trade, your position size. Now this is another one here. I'm just going to point out. You'll see very tight action. See how we tighten up here? Sometimes you'll see where you'll have almost no fluctuation at all. And another thing you want to look for is that when you do break out of these contractions, you want to see multiple days of breakout. Those are usually the best ones. The best ones are the ones that get away from you really quick, which we call hard to buy. They don't give you much of a chance to buy them, and you're sitting there. Sometimes, if you snooze on this when they emerge, you'll be sitting there looking at the rocket boosters up in the air and wishing you got on board. And those are usually the best trades. So you want to see multiple days. If you can get several days of breakout and volume come into the stock, it's usually something that you want to hold. You don't want to just sell it into that first move. Now, you can see here how we just kind of drifted higher, and we had those multiple days, and really the stock just never gave anything up, and then we're back in new high ground. So this is really incredible tennis ball action. And then, of course, again, as we move into new high ground, you'll see multiple days of volume coming in. Now, of course, at some point, you're going to want to sell the stock. You're going to get out of yourself at a decent gain. I mean, if you're setting your stop losses and you're backing into these nice low-risk trades at single-digit risk, you can start getting the double-digit gains, and you're up 20%, 25%. There's nothing wrong with, again, taking off half the trade and then moving your stop up. This was TRN, which we actually, I believe we bought it here when it came from this little pullback buy. So this came in and set up this second T here, and as it started to emerge here, then it undercut this little low here, which created a little short-term shakeout. And then you see how there's just one day. That's a T. That's what we call a pause pivot. That should be your actionable level, especially if the volume contracts there. Let's see if we got here. Here we go. Zoom up here a little bit. And you'll see here, we got volume came in and contracted. We didn't get much volume coming out in the initial breakout, but it held up pretty good. You started getting some volume coming in a little bit later on. Then you got a normal pullback here. Came back just below the breakout. You shouldn't have been stopped out if you're using a relatively tight stop here. And then, of course, then it went right into earnings and gapped on earnings and moved higher here. Now, let's move down the ladder here to the left side and talk a little bit about being a little more creative with the pivots. All right, for those of you who like the bottom fish, I very seldom will ever try to buy the low, like when it just starts to just turn up, a stock selling off, and it just turns up from the low. But I do have a few tricks in my bag that let me get pretty close to it if the stock sets up a pivot point and gives me some volatility contraction. It's a little bit different how this takes place. It occurs, like I said, around the lows. This is Google. And you'll see, and I think this example is in my book actually, you'll see how we correct here. This works really well for bigger cap names and also for new issues that may correct and as they come in, because very often you'll get a new issue, it'll run up on the IPO, and then it corrects in. It may be for a number of days, weeks, or even years, but at some point you might get these low pivots that set up. And you can see here where, again, we're contracting very tight, and we're getting that little low pivot. This is what we call the low cheat. Again, you can read about this in my book. The reason why I'm showing this is that if you look at Twitter, it's almost identical of what took place here. We'll see you have the initial, although it didn't rally at all on the IPO. If you remember, Twitter just came right in here and then came up and set up that low little cheat, and that's where you can be entering, because sometimes what happens is, and this is why we want to have multiple ways of getting on board a potential big winning stock, is because sometimes you don't get that VCP to set up on the right side. Sometimes it just runs up from a low pivot. So even if you buy a small position, at least you have some position in the name. You'll see Twitter just kind of ran up this right side and really never paused but for just one day. So it didn't really give you that VCP. And also Google did the same thing, where you see it just ran straight up the right side. They gave you sort of a high little sloppy pivot up there. But this is a way you can get on board here. And you can start to be a little creative with these things. This is WUBA. This is more recent. Some of these are just tradable. They're not necessarily where they're going to make these big giant moves. Most stocks don't make big giant multi-year moves. However, that's okay, because if you're able to time your trades effectively and you're able to make 10, 15, 20% in a number of days or weeks or even a month or two, that compounds very rapidly. I made millions of dollars and most of my money in shorter term moves. And when I say short term, I'm talking days, weeks, and months, not day trading, but as opposed to finding the biggest winner of the year and being up thousands and thousands of percent. I've been in virtually probably every big winner that's out there at some point in time, but it doesn't mean that I necessarily participated in the entire move, and you don't have to. Again, it's all about timing and managing the risk reward relationship. And when you use these tight pivots and these volatility contraction setups, what you what you accomplish is all of that. Your timing is very precise. You know very quickly if you're right or wrong, so you don't tie your capital up very much, and your risk is very small. So when you have this opportunity to have a stock that explodes like this, you're taking a very small risk. You could be wrong many times, and it will pay for itself. Okay, you're not gonna, just like playing aces or kings, are not gonna work every time, but you're gonna do pretty good if you push your money in the center of the pot in poker with aces or kings. Here's another trade that recently set up. You'll see this is GOMO, G-O-M-O. Again, being a little more creative here, you'll see how you came off here. And again, I'm not going to try to play right off the low, because generally it's very hard, first of all, to know when the exact low is. Sometimes you get a little rally, then it just comes crashing down. Also, you want a little bit of time to go by, to round that off and be able to go through a natural process of digestion, like I was saying, that supply that comes to market. But again, this set up a nice little low pivot here. This is being a little more creative, and you'll see it's not as clear-cut tightening here, but it is a viable pivot. And again, you didn't get another pivot point. It just ran right up the right side. So you'll be able to take advantage of that. Now, sometimes they happen even a little bit differently. This is another one that, and this is HIMX, I believe, right? Yeah, HIMX, where you'll see you set up here and you're below the 50-day, and this is being pretty creative to use a pivot point like this. But you'll see the very nice tight price here, and you allow the stock to go through some time, undercut a previous low. Now the key to this is that when you're under the 50-day and you're using these pivot points that are in the lower register of the setup, you have to remember that you really want to see them move pretty fast and strong, because if in fact the stock is bottoming, usually it's going to come pretty fast off the lows, and you want to see some pretty good action there and it hold up. In this particular situation, that's precisely what took place. I'm going to just zoom up over here another. You'll see that when you got above that 50, you see the volume came in nice and strong, and you just tightened up for 1, 2, 3 days, and then again you're right back. Volume comes in, you break out again to, above the previous high. Then you come in 1, 2, 3 days. The 4th day, you're right back up again, and you're back in new high ground. This is classic tennis ball action. 1, 2 days back in new high ground. See, and this, you should be sticking with this, as this is showing you this type of action. You want to stay with the stock for a little bit. And then as we get over here to the right side here, see it sets up again. And maybe you reduced and you added back over here. That's possible. Or you just sold the whole position, then you came back in it here. Or you never even saw it, and this is the first time you've seen it. So over here you'll see we break out. Same thing, VCP, but this time it doesn't work out so well. You get this sell-off here that starts that takes place shortly after. You don't get much follow-through. And then as it just sort of dies here, this is what we call a ledge. This is not a good sign when you just start turning it into like a square, and then you start to sell off here, and the volume starts coming in the stock, and of course this broke down from there. I think we actually tried to trade this. I got stopped out of it. Now, this one's even more creative. This is when you're trying to play a shakeout, or what I call a bottom fishing pivot, and this is really what I would refer to as we get more and more to the left side and to the lower register of the setup. We're getting to more and more expert buys, okay? And you want to be very careful with trying these until you get the hang of getting the classic setups down, and you're getting some success with that. Now, of course, also a lot of this lends to what type of personality you have and what you gravitate to. But what we're trying to do is give you enough opportunities to be able to up this entire right side. After a stock goes through a correction, which all stocks will do, we want to be able to, at some point between around the lows to where it gets back into new high ground, we want to be able to get on board that stock and be able to participate in that next up leg. So by having a bunch of different techniques at different levels, if it doesn't set up here, it might set up here. If it doesn't set up here, it might set up here. Of course, it doesn't set up at all, then we're going to have to pass on it. But we'll have a bunch of tools in our bag to be able to try to take advantage of this. Again, this is a very, very low creative pivot. You'll see that we have this pivot point that develops. We shake out this low a few times, and then we get very tight, and you'll see how the volume comes way, way in. So this is the type of situation, again, where I'm going to want to see it immediately move up. if this moves up and then can't flounders around and starts drifting off, I'm not going to stand that for any time at all, because these reversals right here, the shakeout and the fact that you had good closes on the reversals, that is showing you that there's some potential demand here, and once it tightens up and the volume comes in, you develop that line of least resistance. You want to get right in there, and it should move right away. So again, the benefit of this is being able to know very quickly if you're right or if you're wrong, and not tying your money up. Now, you might remember this trade. This is BBT, which we bought recently. This is really just a classic 3C, which we call a cup completion cheat. This is really up until I started using the low cheats and these bottom fishing pivots, which again are much more the exception to the rule. This would be the earliest point that I would ever even enter a stock. Would be you have to see the stock make what we call the turn. I'm not going to get into that too deep here. For those of you that are new, you can read that in my book about the turn. But this would be the first point, and this is where I would focus most of your attention on, is looking for the turn and looking for those pivots as you go through that VCP. Again, just you want to see the stock come out, hold up relatively well, and follow through. One second. Now, the other thing to look for is what we call a failure reset. Now, again, these are topics that we can go on for hours on just one topic, and we do that at the Master Trader Program. We flush this stuff out for 2 whole days, and we're able to get into it a little deeper. Here, of course, on the platform, we kind of give it to you in dribs and drabs along the way. It's more about real life examples, but you have 2 types of resets. One is of a pivot reset. That's where you'll have a stock starting to form a VCP. And in this particular instance, you can see we tighten up right here. It tries to come out, but then right away comes off and comes crashing down. And that's where the pivot point fails. Now, the base hasn't completely failed because we haven't really taken out the low in the base. Being that we've come inside what the previous decline was, this could just be a second T setting up, which it turned out that's what it was. Here's your first T from here to here, second here, and third here. So this could be a potential reset. Now, if this was a complete base failure, then you have to go through a lot more time, and you have to reset. The bottom have to come up the right side. You have to rebuild the right side. But if you just come back and get stopped out, you shouldn't just walk away from the stock and scratch it off your list. The fundamentals might be there. Maybe the market came in real hard for a few days, or maybe there was some news that brought the stock in, or some downgrades, or whatever reason it might be. You still want to, if you've done your research and you see the earnings are there, the sales are there, things are intact, watch for a reset. And very often you'll get a shakeout because you have a lot of short-term traders in there. And you're not the only one that knows this. There's a lot of other people that read my book and read O'Neill's book and read Livermore and read Nicholas Darvis and whoever else. And they're in there buying also. Although I will point out that if you think this is popular, that people are spotting this, and this is something that everybody sees, I can assure you that if you're using these type of techniques, you are in a very, very small percentage. Probably in the less than 1%. So, and then of course, why do these stocks go up then if so few people are doing it? Because the real buyers, the institutions, are the ones that are moving these names. Now, again, the pivot resets can happen very quickly too. It may stop you out and reset just a number of days down the road, or a week or 2. So keep your eye on that. Now, let's see here. Just going to move over that. Again, you can see here, you see how you get this real tight action? Just showing you, I'm going to show you a few different ways that these pivots can manifest themselves. Again, letting this go through some sideways action, create a little shakeout here, then it gets real, real tight, and you see the volume comes in quite nicely, and then explodes here on big volume. This is only a tradable situation. It didn't last that long, and of course, as we get later in the market, this is a stock that was it was pretty recent. So a lot of these names weren't able to make as big moves because we've had such a big multi-year bull market. But again, this is a nice tradable situation, up over 20% in a very short period of time. Then goes through this basing. I remember we I think we tried to play this here a little bit as we tightened up real nicely here. But again, right away, you see, you know immediately that this is not working out. And you just come out of this little tight area here and look at the volume. Just comes in really nicely, but then can't emerge, can't follow through very well. Volume doesn't really come in, and then very quickly just comes right in. Volume picks up. You got to be out right then and there and not really wait much longer. That's a clear-cut sign. So again, you know very quickly if you're right or wrong. And here's another stock here, and this here is an AFSI. Sorry about that. Sorry about that, jocking this all around here on you. Again, you see here, you know, this is one that, you know, maybe you came in here and you'll see it didn't quite come out very well. It had that squat, and I won't normally sell just because the stock fails to break out in squats. We're in that situation right now with KMB. I'll pull it up in just 1 minute. I'll give it a chance to put in what we call a reversal recovery. Sometimes it'll take a few days or 5 days or even up to, you know, a few weeks, and it'll get back into new high ground, which is a positive sign if you can then take out that high, and then you want to see it hold that pullback low once it can move and recover. However, if it can't recover and it pulls in and doesn't really break out very strong and then starts coming off again, the volume picks up, then you know really something's not right there, and especially if it just tries to rally again, comes over, and you can see you're getting one strike after the next. First it reverses, then it can't recover, then it sells off, closes below the 20-day, tries to tighten up a little bit, still can't manage to put anything together, then comes below the 50-day, volume picks up. You should be selling stock all this time. If you're not kicking the whole thing out, you should be piecing it out, and by this time here, you should be completely out of the stock. Okay, so that's the tutorial today, and we could go through some questions. I can go back to slides if you'd like. Also, I just mentioned KMB. Now, here's a situation that looks very similar, doesn't it, to what we just saw, where you almost identical actually, where you try to break out into new high ground and you come off and you come in. Now remember, this is during a general market that is very weak in the last few days or so. So this has not hit my stop yet. My stop is at 108, okay, which is down here at the low of this sort of where it started tightening up, which is a pretty reasonable stop. Even if you were buying it breaking out here, as it came out the other day, and that was the first time you were buying it, you're still looking at letting it come all the way down to that stop, only about 3.5%. So you have a very, very low risk here. Now, you'll see it's trying to recover here. You know, it's not looking great, but it is definitely holding up and trying to stage a reversal recovery. So we're going to stick with this. However, this comes crashing down here, and it tries to recover, and it can't. And then starts taking out these previous lows. I might even get out a little bit before the stop, but right now, so far, it's holding up relatively well. So that was just another situation that looked very similar to that last one that we were just talking about. Yeah, so Joe's asking if I can comment on yesterday and today's market action and the reversal. So let's bring that up. You know, this played out pretty much exactly like we were speculating would happen. If you remember, of course, let's just kind of go blow by blow here. This little yellow hash mark was where we went on sell alert, and then this red hash mark here is where we went on an outright sell signal. So then we came off for a little bit, and as we came back up, we went on buy alert, which doesn't put us on off a sell signal. It just means that it started to have a heads up that it could. And that you'll see, we rallied just for a few days, and I talked about how these rallies may only last, 2 to 5 days is what you have to watch for. And if you see 1, 2, 3, 4, 5 days on the 5th day, and then if you remember, we was doing a little shorting over here. We went right back on a sell signal here, which, well, actually we didn't go off the sell signal. We went off of buy alert right here on this red mark. Sold off, and since then you'll see again a little rally 2 days, then we sell off. Just take a look at these rallies. 1, 2, 3, 4. 5th day we sell off. 1, 2, 3, 4, 5, sell off. 1, 2, sell off. Now again, we're in a situation here. We try to rally off the lows here, and now we're on the 2nd day. So I'm not going to really put any faith in this market until I see the 4th, 5th, 6th day that I start to see some big volume come in this market and really show that it can come back and it can follow through. Okay, that's one of the first prerequisites I'm gonna look for before I start buying anything aggressively. But the very first sign that we were talking about was getting an undercut of a low. And if you remember, these last few weeks I said that this low was in jeopardy and we probably would undercut it, and the 200-day could act as support. You can see that's exactly what took place in the NASDAQ. We came below this low and bounced right off the 200-day. Now, we've got to see here and watch. It's very important to watch what happens over coming days and going to next week and what happens with the individual stocks. Right now, there's not a whole lot of stocks setting up. It's just basically like the market. There's a lot of names that are around their lows, and I'll pull a few of those up and we'll look at them. And we're in that point where we'd have to be pretty creative on the entry points, using those pivot points off the lows to really get involved with too many stocks right now. So at this point, we got that nice quick reversal. We got the big volume off the low, so that was a good sign. But now we got to look at some of these individual names and see how the leaders are acting. Now, let's take a look at Facebook, for instance. Here's a stock that we've come down here. This is the 150-day. And again, I would want to see maybe some tightening here. Maybe I like to see these pivots. I like to see us go inside, inside day for a day or two. And if we did something like this, we tightened up a little bit and maybe came up from there, getting through this level, I may be interested in trying to, bottom fish this with a bottom fishing pivot point. This could be interesting if we tighten up and we have the volume come in here. I think if this market is indeed bottomed here, you're probably going to see some of these names like maybe Facebook, Priceline also may start to put in a pivot point here somewhere. But you'll see, look, we're just in a downtrend here. You see, we haven't even started building that right side yet. So you're not going to get a V move here that goes straight up usually without some type of pullback. So again, you want to wait for a little more reliable action here. You take a look at some of these names. Google, see, in a downtrend here, just rallying back to its downtrend. A few days of rally will just get this to rally back to this downtrend. CMG, which has earnings coming out, may rally back up here. Let's see. Maybe we even get an explosion on the earnings, and it pops big on the earnings, but you probably have to still build the right side and build that cheat area and build the turn. So let's see. Cores, another one. Just again, could rally back here to the downtrend. So a lot of these names have suffered enough damage where they need time to rebuild. Then you have something like a GE, which is some of these names are benefiting from this rotation into the bigger cap value. GE is definitely a big cap value play that I talked about recently that may be trying to bottom here as it pulls back to the 200-day. We got a big pop in Yahoo today. This was the first time that Yahoo came back to that 200-day or on a weekly, the 40-week. In quite some time, and it came ripping back through it. So maybe we've established the low here on Yahoo. But again, we're just running straight up here, and this is a very compressed right side. Again, you can read about time compression in my book. I think we still need to build the right side here, which means that this market probably at the very least still needs time to go through consolidation, at least on a stock-by-stock basis. And we're looking for when stocks are going to move up in earnest, not when the market, the quote-unquote market, the NASDAQ, turns up and goes into new high ground. We could have the Dow go into new high ground in the next few days. It doesn't mean a hell of beans if we don't have stocks setting up, unless you're trading the Dow. So don't be impatient here. Let's look here, a few other things. Any other questions, by the way? Just see what we got here. Daniel's asking, when you say base failure, what does that mean? Drop below the low of the base? Yeah, basically, yes. And on big volume, you're going to see where the stock actually breaks down. I mean, let's see if I can find cores actually was starting to tighten up here. Now, I'm not sure I would call this a base as much as that this is more of trying to set up a natural reaction or what we would call a post-gap play. But you'll see here where we're moving sideways and tightening up quite nicely. I mean, if you bring us on a weekly, we were really getting tight. See this, all these weeks, 1, 2, 3, 4, 5, 6 nice tight little weeks. This was setting up in a way where, if this moved in the other direction, I may have been a buyer there. But you'll see it broke down and took out the low and really has broken apart here. This is an outright base failure that needs time now to completely rebuild, as opposed to if we just had a quick little undercut of this low, and then maybe it came back. Now I can use my imagination a little bit. Let's just say it came right back here, and then moved sideways and started building a little pivot here for a few days. And it came out from there. That would be a failure that was more of a pivot failure, and then is resetting very quickly. But as you really just break down here, and then especially when you start stair-stepping down, you're well below the 50-day. This needs to rebuild. So that's what we mean by base failure. Let's see. Aaron's asking, RE, supply demand. I understand volume shrinking when supply goes down, but why do we look for high volume for a breakout? If supply is low and demand is high, won't we get a big pop at low volume? Well, it's possible, yes. But here's the situation. What we ideally want to look for is low supply and big demand. That's what makes an explosive situation. So just think about it. If there's only so much for sale and there's a whole bunch of demand, supply and demand dictates that the price has to go up, right? So that's the ideal situation. Now, it doesn't mean that it has to happen that way on that first day. Sometimes it comes in days later, but persistent low demand is a problem. I mean, yes, can it go up on low volume? Yes, it could. If there's very little supply, but it probably won't last very long. At some point, volume would have to come in. So what we're looking for is that explosive situation where we get both. We get the low volume, the supply stops coming to market, and then those institutions that are in there buying the stock, and maybe they pause for a little while as the stock's correcting, are now back with an appetite. Sometimes what happens is the stock runs up on a earnings report or something, and it discounts it. So it runs up 20%, and now as the stock moves sideways or corrects, the fundamentals improve. There's something that's happening in the company, and the analysts are looking at it, and the mutual funds and the hedge funds, and they see something that they like, and they're stepping back up to the plate and adding to those positions and buying more. So it's always adjusting. The market's always adjusting to the underlying fundamental. Let's see. Thing's asking, this one might be early, but what do you think about the HDS recent IPO with excellent numbers? Yeah, I know. I saw that. Let me just. Hold on one second. Just want to move over here. Yeah, I saw this come up on the IPO screen, and it looks pretty good. Right now, this is a little sloppy on the right side. It did come up nice here. I like this, how we broke out, stalled out a bit. Of course, the market hasn't been that great. So I think this is one to look at here. Let's see, it's pulled back now from the highs. About 10%. You have a pullback buy that tried to trigger today, but again, with the market so early and just showing some initial signs of bottoming, you got to be a little careful. What I would do is I just be smaller positions and just follow those 10 steps to reduce risk, and you could try a few things here. If you want to try a few that are starting to emerge, you may get some key stocks that are coming right out of the gate if indeed you nail the low. If the market is indeed bottomed here, even if it undercuts, you may get some of the stocks have already the better names have made their lows. So I think it looks pretty good, but I think it's a little premature. And at this point, I also want to look at some of those key leaders, something like a Facebook or a CMG, and some of these names, Priceline. I think if this is just a correction within an ongoing bull market, that a lot of those existing key leaders should probably find their lows and also make some moves here and move up and and provide some decent buys. So we do want to see new leadership also, though. So I think it's good that you're looking at this. Okay, question on Microsoft. Well, Microsoft's acting pretty good. It's held our stop, which is great. In this market, we broke out here excuse me, we broke out here, right as the market was getting into trouble and experienced a lot of distribution. So I think for Microsoft being, a name that is a high-tech name, even though it's more of a stalwart now, where it's, a big cap value plays, and that's the reason probably it's holding up here. I think it's doing pretty well. I altered my stop a few times. I had it at break even when the market looked like it was getting in trouble. Now I'm giving it a little more room. If this moves up here and we can get back up near or at new highs, I'll move it back to break even and start cinching it up again. So I think it's acting pretty good. There's not much volume here coming in. So again, like the market, I'm not sure if this is going to need to maybe come in. Maybe the low will hold. It'll tighten up. We'll get some action here that comes in and sets maybe a little pivot point, moves up from there, or maybe if the market's strong for a few days, we can run up and then we'll have to form a pivot a little bit higher. But so far, I mean, I'm looking at this as a stock that I could potentially add to. And if it holds up well through this whole correction, I'd potentially add to this name. If you have a question asking why buy any names or hold any names if we're on a sell signal and the market's not yet where we need it to be. Well, first of all, these names that we're in, we had prior to even really the market really getting into a whole lot of trouble. And also I went into these names because I went into the value type big cap names as sort of a hedge. I started moving, if you remember early on, I started moving some money into some of the banks, and I was going to names that were very uncharacteristic of what I normally would buy, some of these lower relative strength, value type plays, like the BBT, PNC, WFC, Microsoft, of course, KMB. And that in itself, was probably a good sign that the market was probably headed for some difficulty. Just the fact that a guy like myself, who almost never ever buys these type of names, I'm buying these names. So it was pretty obvious that there was a rotation, going into this area. So this was just kind of my attempt at trading it a little bit. And again, always trying to find something to trade. We probably overtrade a little bit here on the platform, and that's why we're trying to, put out the ideas, and you want to be even more selective, I think, and try to, trade with your own personality. The key is that you don't have to be in everything, and you could miss, a pretty good portion of the market as far as, if you're not in there as soon as the market makes a low and starts running up, you still have plenty of time to take advantage of a lot of great situations. So, don't be in a hurry. Then again, of course, don't be complacent and just sit around and do nothing. If the market shows you, you have to just look at the evidence and start making adjustments as the evidence starts painting a picture. So you start seeing distribution. Okay, you see a few distribution days. That's not a big deal. However, now you have a few stocks stop you out. Well, okay, so that brings up the antennas a little bit. If there's a few more that stop you out, well, then maybe you stop buying new names and you start watching carefully your existing names. If it continues to deteriorate, you're gonna get stopped out. You start tightening your stops, and same thing on the flip side. Things start working. You buy a few names, they work out. You buy a few more, and as things start improving and you see accumulation, you see stocks working out, now you can start stepping up. I always say it's not the trading is not an on or off business. It's not an all or nothing business. You can be incremental. That's what's beautiful about this. You could change your position or your decision every minute, every day. It's not like real estate. You go buy a house and you're stuck with it, and you got to go through a big ordeal to sell it and wait for a closing 30 days down the road. This is a very liquid situation that you can get in and out, and that's what you want to make absolutely certain that you take advantage of, because that's your edge. That's the whole reason why it's worth taking the risk. There's much more risk in the stock market, but the risk is worth it because you have the liquidity. So for those of you who don't use the liquidity and don't use the stops and don't manage your risk, what you're doing is you're taking these big risks and you're not offsetting it by the advantage that you have. they're not taking advantage of the edge, and that's where you eventually get yourself into a lot of trouble. One second, I see you. Okay, good question. Drone's asking, if you miss a pivot breakout, how much higher will you buy the stock before you decide not to buy it anymore? I won't chase it up very much, okay? I might, like, for instance, let's just say, let's take Microsoft, for instance, here. Let's just say, here you're looking at this name, and for whatever reason, you miss it, and it breaks out. We got this as it went through 38.43. Let's see, what was the high here? Yeah, 38.46, 38.48. We got some in at around 38.62, 38.70 level. So we were pretty quick on this as it moved through. So let's just say you don't even see it till the end of the day. Now, this is up there quite a bit. I probably wouldn't chase it up here, but the next day it pulls in. If maybe it pulls back and starts to turn up, I might go in there and, as an alternative, if I missed it, buy a little bit on a pullback. I wouldn't buy it as it's selling off. Maybe I'd watch it intraday and it starts to turn up. And if it came back to an acceptable range of where I would have already been buying. So, for instance, I'll buy 1 or 2% past the pivot. Not generally much more than a few percent. If it's 5-10% past the pivot, then I'm not gonna touch it. The risk is starting to increase. However, sometimes I'll wait if it pauses for a few days or pulls back for 2 days or so. I'll use a little pause pivot as it starts to turn up and just set a very tight stop. But you really want to try to buy these things, as they move through that pivot point, because they can move very rapidly, very quickly. And the problem is that the ones that you really want to be in, the ones that get away from you very fast, those are the ones that you want to be in. So the ones that you don't want are the ones that are easy to buy and give you all day to buy them and have those inconsistent or mediocre breakouts. Those are the ones you end up getting stuck with. And you don't want to own. So that's sort of a paradox in the market, that the ones that are easy to buy you don't want to own, and the ones that are hard to buy get away from you, and those are the ones that you want to be in. That's why you really, now, of course, with today's technology, you can set stops. If you don't have an alternative, and that's what you have to do, then you can set stops with your broker. I recommend that you use mental stops, and you go in there and you watch the trading. Of course, I'm sitting here all day watching everything, but not everybody can do that. So you might have maybe an alternative. Any other questions? And keep in mind, of course, that these tutorials are meant to be tutorials. They're not. It's not a complete lessons, but we're trying to spend some time on each topic from time to time, and then more importantly, lead by example and show them in real life. So again, if you want to take this and really flush this stuff out fully, I recommend those of you who have not already been, come to the Master Trader program, because it really is the A to Z. We go over this stuff just in incredible detail with hundreds and hundreds of examples, and I can't stress any more the David Ryan being there again this year. It's just such a great addition. I don't know how much longer David Ryan is going to want to do the Master Trader program with me. Hopefully it's for many more years, but I can't say. So I would just for that reason alone, I would attend just to go see him. So anyway, let me see. I think I got all your questions. Just give you guys a chance if you have any other questions here. For those of you that are new, because we tend to see that a lot of new people don't ask questions right away, or they don't ask questions at all. And sometimes we get a lot of email questions, but we don't answer email questions. We try to do it here in the room so everybody can benefit. And there's no such thing as a bad question, or don't think that you're asking a question that you might feel stupid of asking something that is obvious, or you think it's remedial. This is all very fundamental. It's really important to focus on the stuff that's the most basic and most fundamental. Like Vince Lombardi said, he's going to learn how to run, we're going to learn how to run, block, tackle, pass, catch better than anybody. It's the same thing with this stuff. Sometimes it seems simple and obvious, but there's a lot of complexity here. And I've spent tens of thousands of hours going over these pivot points and analyzing these stocks. And I have a model book that now is over 13,000 pages of examples. It's literally 10 feet tall. It's in 50 volumes. So we just keep building these models and trying to perfect the basics and get them down so we can execute them flawlessly. So there's just ask questions, and this is the time to be able to utilize my time and my expertise. And from time to time, David will be coming into the room. We were fortunate; we had a session with him, and this is the time to get those questions answered. Yeah, we based the contraction in volume looking at previous day's volume, previous week's volume, and also above you can use a 50-day average or even a 30-day average or 40-day average some people use. And you can also see the volume relative to the previous volume. So you can see, like with Microsoft here, you can see on how the volume here really came in relative to the previous volume and relative to the average volume. This is the 50-day average. And then when it started to move out here, you can see it got way above the average volume and also took out all this previous volume that was in this little range here. So that's how you want to look at the volume. And there's specific points at which the volume is really important to look at. It's usually where I'm really focusing on is, let's see here, I'm focusing around the lows and as we come up that right side, and then I'm focusing on the pauses, and then how when we emerge above those pauses on the right side. The left side, as we come up, you can see lots of selling volume and all kinds of crazy spikes and stuff. That's the that's the stage at which the stock is selling off, and then it capitulates. And once I see there's a low being established and we're starting to get some right side development, that's where I start to key in on it and really start to look at the volume characteristics and the price. So if you're just in a nosedive, it's not something that I'm really going to be interested in. So I'm not really keying in on it at that point, not until you start to get. And that again, that's why right now you've got, even though this isn't like a big bear market, this is a relatively small pullback in the indexes, although there has been some damage. There's a handful of names out there that are down 40-50%, and some of even the bigger names are down 18, 20, 25%. So it's a healthy correction here, and that leads to having a right side need to develop and at least have some type of right side development. That's what we want to watch for. All right, so I'm going to wrap this up now, and I would monitor the platform very closely going forward here, because again, things could change very quickly here. I mean, with this accumulation off the low here, we could have already seen the low and very quickly be back into some of these names here. We may also see the indexes move higher and you don't get much participation in names. So don't think if all of a sudden the indexes go up and the Dow and the S&P are just a stone's throw away from a new high. They could go into new high ground, and we still, the Russell and the Russell 2000 and the NASDAQ still have a lot of work to do, and the individual stocks really aren't set up yet in earnest, and we could be on the sidelines for a little while. So for those of you who are not haven't been with us, don't know what to expect, that's a possibility. So it doesn't mean that the system's broken, or we're not watching and we're missing it. As things set up, we'll point them out. And but we've seen this market come off and come back in short order. My gut feeling, I know I had a question about my feeling about this market from my gut, my experience. My gut feeling is that we're going to get a rally, and we're either going to come down and take out the low, or we're going to get some more sell-offs that are going to be, there's going to be some volatility. There's going to still be some back and forth action, and it's still going to be a difficult environment for a little bit, even if it's for a week or even a few weeks. I just don't sense that it seems a little too obvious to me right now that we came down and kissed the 200-day on the NASDAQ, and that's the end of it, and we're going to turn back up, and everything's going to be okay again. But then again, you know, it's certainly possible. But what I try to do is just watch the stocks, watch the you know, the risk model and the indexes with the accumulation distribution, and try to keep it as simple as possible, and focus on making the best risk reward decisions that I can make, and managing that, you know, on a regular basis. And that's been the key to my success for all the years, and it's a consistent formula. So just stick with that. I'll see you guys tomorrow on the platform. If there's any major developments in the market, any major changes in our position, or we're starting to see anything that's really something that's important, I'll come back in the room and we'll discuss it. Otherwise, we have a 3-day weekend coming up, and Easter coming up. I hope everyone has a safe holiday. Enjoy time with your family. Forget about the market for a few days, and enjoy what's most important, and that is your family, friends, and your own health and well-being. I'll talk to you guys later, and I hope this has been helpful. Bye-bye.